Before you start spending hundreds of dollars, if not thousands of dollars with virtual platforms, you might want to watch this video. Okay, so you've probably seen videos on social media like get funded today or trade $100,000 account with no risk, and you might be wondering, how do these platforms actually work? Are they legit? Is it too good to be true, right? You might be having all these questions. Let's break it all down, okay? Old school model, new model, how platforms operate, the math that no one tells you about, and, if it's actually worth your time. So let's go over first the traditional platform model. So what even is a platform, right? What does it even mean? A traditional proprietary trading firm is a company, okay? That company could be a bank, could be a hedge fund, could be a trading desk that backs you with their capital, okay? You trade their money and you both split the profits. You'd usually apply through a job listing, sometimes literally in the newspaper like back in the day, go through several rounds of interviews from math tests and logic puzzles, and if you were accepted, you'd be trading with the team right on site, okay? Whether that's at a trading desk, again, a bank, a hedge fund, you'd have to relocate, go to where that company is trading from, and trade with the team there. Now, big names like Jane Street, DRW, Citadel, SMB Capital are considered traditional platforms. Here's something wild though that I actually got from one of the articles from Jane Street and Citadel. These firms, right, they get thousands of applications and accept less than 1% of traders. So you have 1% chance of actually becoming a platform trader. Some top firms are even sitting at 0.1% to 0.5% acceptance rate. I mean, as you can see, it's ultra competitive. It's like trying to get into Harvard, but for traders. And I would say even more difficult to try to get into Harvard because Harvard acceptance rate is a lot higher than that, okay? So how does the virtual platform model work, and, how is it different from the traditional platform model that we just went over? These will be online platforms, okay, where anyone can sign up, pay a fee, and attempt to qualify for what's called a funded account. All from the comfort of your bedroom, right? So you could be doing this anywhere you are, right? You don't have to be physically in the offices. Now, instead of interviews and tests that, traders had to do for a traditional platform, you get a challenge, also called an evaluation, where you're trading a demo account, but with real market quotes. So how does that work? You have to hit a profit target, okay? Which basically that's how you pass these challenges. You cannot break the rules, right? Every platform has different rules that you have to abide and stay within a maximum loss limit. Okay, this is the only rule that actually fails a challenge, right? If you hit this maximum loss limit, the challenge will be considered failed, and then you're funded. Okay, so those are the steps on a high overview how to get funded, right? Now, some use a two-step evaluation, like FTMO, for example, which is one of the biggest CFD platforms. Some use a one-step, for example, Topstep, one of the biggest companies in the future space. And then there's other firms like Top One Futures, who now also are offering instant funded accounts, where you can skip the challenge and get the funded account immediately, again, paying a fee, which will be a higher fee in this case. Now, different from a traditional platform, here you have to pay to play, okay? Traditional platform, you have to go through those rounds of interview, you have qualifications, right? But you don't pay a fee to actually trade with them, right? With these platforms, because you're skipping all those steps, you are going to have to pay to actually get a chance to play these challenges. Now, if you fail the challenge, you lose the fee and you have to pay again to retry, okay? All your risk is the fee, okay? You are not liable for any of the trading losses. This is not a loan of any kind. I'll not emphasize on this because we always get questions. Is this a loan? Do I have to pay this back? No, okay? The risk in virtual platforms is not market losses, okay? It's evaluation fees. That is the only risk. Again, you're not risking your own trading capital, but if you break the rules, right, if you hit the maximum loss limit, then you will lose that fee. And, these fees could add up really, really quickly. So I made a little chart here for you guys just so you can understand exactly the process, the roadmap here. So let's say you are in this position right now, an aspiring trader with little to no personal capital. You join a platform, okay? You pay a fee, as you can see, that is the fee that I was talking about, and then choose an account size. There will be different account sizes which you can choose from, anywhere from $25,000 account to $50,000, $100,000, and more. Okay. Now, question is, does the trader pass the challenge or not? Does he or she pass that evaluation? If they don't pass it, then they have to pay a fee again to restart this evaluation. Okay. But best case scenario, let's say they do pass that challenge. The funded account is provided, but it's only activated if they pay the activation fee. Okay, so there will be two fees on the virtual proffer model. One fee you pay during the evaluation phase, and then there's an activation fee that you pay only, and if you are funded, only if you do pass that challenge. Okay. Now, what are the results on the funded account? Worst case scenario, you hit that maximum loss limit we were talking about, right? Trader hits the maximum loss limit and loses the funded account. You have to restart this process all over again. Go to the challenge, complete the challenge, pay the fee, pay the activation fee, and restart. Okay. Worst case scenario. Best case scenario is trader makes profit, right? And trader chooses to withdraw profits because obviously you guys are asking, how do we get paid from this, right? So if you do make profits on your funded accounts, then you can choose to withdraw those profits. Prop firm gets the split 10% for the prop. Usually 10 to 20% is the fees that a prop firm would get. And the trader gets the split 90%. Again, 80 to 90% depending on the firm. Okay. This is an overview of how a prop firm model works. Again, every prop firm have their own rules, have their own daily loss limits, have their own restrictions, right? But at the end of the day, what you want to pay more attention to is going to be pricing, is going to be rules, is going to be payout policy, is going to be trader support, fast payouts, and reviews, right? Transparency, all of that. I wanted to show you an example of what an evaluation looks like, what the prices look like. So I just took Top 1 Futures one-step evaluation as an example. As I said earlier, Top 1 Futures does actually have a instant funded model, but I just wanted to take their evaluation program because it's much more similar to what the rest of the industry does. Okay, so as you can see, they have 4 different accounts: a $25,000 account, $50,000 account, $100,000 account, and a $150,000 account. For example, let's focus on the $50,000 account here. You will be paying a price of $49, as you can see, per month. There is a monthly price for these evaluations until you pass them, right? So for example, if you hit this profit target, which the profit target in this scenario looks like it's $3,000. So if you hit the profit target within the first month, then obviously you only pay this fee once, right? But if it takes you more than a month, then it will be a monthly fee until you pass it. They do have a daily loss limit. For example, on these accounts, it's going to be $12.50, which a daily loss limit only prevents you from trading more that day, right? It does not fail the challenge, but it stops you from trading that day more just to limit the losses that a trader can do. A max drawdown of $2,000. So we talked about having a maximum loss limit. That is that $2,000, which if you hit this, then you lose the challenge and have to restart over. The drawdown mode, very important to look at end of day versus intraday. I believe I have made a video on this as well, explaining the differences. You can see the maximum contracts that you can trade, minimum days that you can pass. Is there a consistency rule on the challenge? Is there a consistency rule on the funded? Reset fee, activation fee, right? So this is the activation fee that I was talking about. Once you do get funded, you have to pay this. Payout policy, maximum number of accounts you can have, and so on. So this is going to be a similar structure that you see when you start researching about prop firms. You will have a similar structure where they give you all the numbers, all the rules, and at the end of the day, you make the decision if that prop firm or if that account size is right for you or not. Now, what no one talks about, okay, is going to be the A book versus B book. Here's the shocker. Not all firms are putting your trades into the real market. So I know it's crazy to say, but most virtual prop firms run a model called the B book. That means that even your funded account is still simulated. It's still a demo account, right? So we talked a few minutes earlier that, hey, an evaluation is going to be a demo account, but with real market data, right? Now, even if you get funded, you're still in a demo account. You can take payouts, you can get paid, you can get that 90% split, sure, but you're still trading on a demo account. Now, the firm doesn't send your trades into a real exchange. On the B book, they do not do that. They're just tracking them internally and just collecting data. Now, it's up to the firm if they copy your trades with the real company accounts or not, right? So if a company has their own capital and have their own trading accounts and they just use this profit model to see who the best traders are and they just copy your trades, they could do that, right? Not all companies do that, but they have that option, right? Now, how would they pay you, right? You're like, how does this company even make money then if I'm not really making money for them into the real markets? Well, they use the challenge fees from other traders, okay? So the fees that you're paying, the challenge fees, activation fees, basically that's the revenue. It's a model that works as long as more people lose than win, which is just crazy to say, but basically that's the model, which, hey, it's commonly known that 90% to 95% of traders lose money in the long run anyway. So it is a statistics game that they are playing here as well, right? So again, a company that has only a B-book model, as long as more people are losing, so as more challenge fees that they're getting and the less they're paying out from those fees, the better for this company, okay? Now, there's also a more sustainable model called the A-book, okay? Where your trades are actually hitting the live market. And here, the firm actually gets paid from you from the 10% split that it receives, right? Because, again, on the B-book, the 10%, you're not really, winning that for the company. It's just a 10% that the company gives to itself in a way, right? The 10% profit that you make on an A-book is 10% of profits that you took from the real markets, okay? From other traders out there, from other companies out there. Now, ideally, a good firm uses a mix of both, right? So a B-book is used mainly for evaluations and demo-funded accounts until a trader proves himself, right? And then what the company does is they move them to an A-book account where now they can actually produce some income for the company as well. Now, that's the type of prop firm you want to be trading with, okay? Because this prevents the prop firm from going under in an event of a trader getting a big payout from a demo funded account, which technically comes from the company's revenue on evaluation fees, right? So if a company only has a B book, right, and there's a big trader that takes a big payout, $2 million, $3 million, the company has to get that payout from their revenue, from the fees that other people are paying, right? Because that $2 million, that trader did not make it into the live markets. They just made it into a stimulated environment, and the company's paying them from their own pocket, okay? It's a very risky model. Please, please, please try to go with companies that also have an A-book in their model, okay? Usually it's a evaluation phase. They move you to a funded account phase where it's a demo, and then they should have a third tier where it is a live funded account, okay? Now, before we wrap this up, I just wanted to give you guys some of the math when you are doing your research, just to see exactly what to look for. Again, we talked about looking at the company's reviews and looking at the company's payout policy and all of that, right? But looking at the math is important too. So again, it's very simple that 10% of $1,000 is only $100, and 10% of $100,000 is also $10,000, right? So this is the reason, right? This is the reason that people use funded accounts. So they have bigger capital to trade with, right? And the 10% means more, right? 10% of a watermelon is definitely more than 10% of a grape. But are you actually getting $100,000 if you go through a prop firm and get this $100,000 account, right? Are you really getting this money? Yes. I mean, maybe not, or yes, right? So yes and no. So let's say all the fees included, evaluation fees, activation fees. This account costs you $250. So I mean, paying $250 to get 100 grand, I mean, sounds great. But the real drawdown in this account is maybe like 3,500 or something. That means that your trading buffer is only 3.5% of the account, okay? Look at these numbers again. So you're paying $250 for a $3,500 drawdown, which, again, it's still 14x on your investment, right? It's not small, but it's not like you're getting $100,000 worth of drawdown. But still, 14x on your investment is still really good. Now, if you lose the $3,500, if you hit that maximum drawdown before taking any payouts, the account is gone, like it disappears. and so is your $250 investment. You would lose that investment as well. So in a way, it's still better, right? Because instead of losing $3,500 of your own money, you just lost $250, right? But just so you know, it is not $100,000 that you can't lose on these accounts. Now, yes, I mean, the numbers work, but they only work if you work, like if you put in the work. Because yes, it's better to lose $3,500 than 250, but if you keep losing this over and over again, the fees will add up, you know? So what does that $100,000 number actually mean then, right? Why are these companies putting 50 grand and $100,000 accounts out there? Like, why are they even putting these numbers out? So that is called buying power, right? So you do actually get a buying power worth of that much, right? Margin, let's call it leverage, because these products that you're trading, you know, futures and other products that you're trading, they are leveraged products. So the 100,000 is a real number, but it is a buying power. It's not actually drawn on those accounts. So let's actually look at what the real numbers are and, you know, what makes sense most. So again, I have the top 1 future evaluation phases here, so you guys can see exactly the cost breakdown for all of these different accounts. So the real value of a $25,000 account is only $1,000, okay? Because that's basically the maximum drawdown. So the maximum drawdown on that account is $1,000. That's the max you can lose there, which in this example, it's a 5x return if we consider someone that passes the evaluation in their first month. Okay, so let's say $34 plus the $149 activation fee, right? So if you look at those costs compared to how much you can lose, that's a 5x return. Again, not bad. Profit drawdown ratio is something that you want to look at as well. Like, how much could you lose compared to what your profit target is? And that's what we do by comparing your maximum drawdown compared with your profit target, right? So in this example, your maximum drawdown is $1,000, which is 4% of your account, while your goal, your profit target is 6%. Okay, that's basically a 1.5 to 1 profit drawdown ratio, which is good. It's on a good scale. Real value on the $50,000 accounts is going to be $2,000 because that is your maximum drawdown, and that is a 10x return, okay, on your total costs. Profit drawdown ratio, 6% and 4%, 1.5 to 1. It stays the same here, right? So it's a very good profit to drawdown ratio, right? So the closer this is, the closer your profit target is to how much you can also lose, the better, right? Because you don't want to be in a position where a company says, hey, you know, you got to make 10 grand, but you can only lose $1,000. You know, that is a crazy profit drawdown ratio. That would be a 10 to 1. Pretty crazy. So the lower it is, the better. Let's say you get a $100,000 account. Real value in that account will be $3,500, which is the example that we were going over on the previous slide. That is a 14x return there. The return's getting better. Profit drawdown ratio, 6% stays the profit, but the drawdown ratio drops to 3.5% here, okay? So the ratio goes a little bit higher, 1.7 to 1. So you have to make a little bit more compared to how much you can lose in these accounts, even though you're getting more value for your dollar, okay? So you're paying less for something that gives you more in return, but it's a little bit more difficult to manage, right? And then lastly, for the $150,000 account, $5,000 is the real value. That is the maximum drawdown there. That is a 16x return, which is the highest return out of all of these here, because again, it's going to cost you $149 to pass the evaluation, plus another $149 to activate it. That's $300 in costs compared to you. Potentially, you could lose up to $5,000. Okay, that's 16x return. The profit drawdown ratio here drops a little bit lower though, from 6% target. That is the same. Now the maximum drawdown, even though in dollar value it's bigger, in ratio percentage-wise it is less, right? So it's 1.8 to 1. Okay, so if you are looking at dollar value, dollar return, obviously the bigger the account, the better the return it is, right? The best buck for your dollar. But when we're talking about ratios and percentages, it gets a little bit worse as the accounts are bigger and bigger, okay? Again, the same math I did here. This is the type of math that you should be doing for any platform that you are using out there, right? And you're saying, okay, what makes sense most for you? So after going through all of those facts, okay, and all of those statistics and math, question is, are prop firms real, right? So some absolutely are. Some maybe not as much, right? So there are faceless firms out there. Like there's absolutely faceless firms out there. You don't know who the CEO is. You don't know who is managing this prop firm. There's no address. There's no legal docs, right? Um, you can't even get a payout in time. Payouts get denied, right? So there's a lot of that, right? But there's also companies that have the good support, have the 24/7 support, have payouts on time, have fast payouts, have clear rules, have clear paths to getting a live account, right? That's what you're after, and those firms are real for sure. Now, in reality, only about 6 to 10% of traders actually do pass these evaluations. At least that's what companies like FTMO and Topstep have disclosed in the past. And only 1 to 3% actually get a payout. Now, those numbers might seem slim, but if we go back and look at the traditional prop firm model, you saw that 1% of traders don't even get accepted to trade in the prop firm, not even think about getting, profits. 1% was, the acceptance rate from a traditional prop firm. So I'll say 6 to 10% to pass an evaluation phase. I'll say it is still a little bit high, in my opinion, compared to those numbers there. Now, the reason why that happens is just because most people don't follow the rules. Most people don't even understand the rules properly, don't do the math that I was doing on this video, right? They over leverage, or they just treat this like a scratch ticket. Because it's so cheap to start, and because there's no barrier to entry, like you don't need a degree, you don't need certain trading experience, right? There's really nothing stopping a random person on the street from opening a prop firm account, right? If they have $34, they can open the lowest account, right? The $24,000 challenge, and they can just start. So I think we can all agree now that prop firms are real. But if we look at just the prop firm industry overall, I mean, is it legit? And the answer is yes, right? But at the end of the day, it is business, right? It is a business. And here's the ugly truth. If you do not trade properly, if you do not take this seriously, you will just be donating your fees to another trader's payout. That's the truth. But if you do have a strategy, if you take this step by step, right? If you have a good approach, funded accounts can change your life, okay? Especially if you do not have much trading capital to begin with right now. I'm probably going to attach at the end of this video a comparison that I made with Topstep and Top 1 Futures, just so you can see how two companies are different and how the rules change from one company to the other, just so you can see more examples. But let me know in the comments below if you have tried a prop firm before, if there's a prop firm out there that you're curious to hear more about, and make sure you hit the like, share, and subscribe button. It does help the channel a lot.